Are you wanting to invest passively and make money without breaking a sweat? Dividend investing is the best way to earn a regular return, as it doesn't require you to do much except own shares of a company, which in turn will pay you money. In addition, depending on the company you choose, you can receive yearly or monthly dividend income, as some companies pay dividends monthly. Now, there's a misconception out there that only investors who are nearing retirement can benefit more from dividend stocks. But that is far from the truth, as dividend stocks are beneficial to any investors, especially in terms of diversifying your portfolio. In that case, how do we start to proficiently invest for dividend income now? And how can we identify which dividend stocks would provide you higher return and ultimately help you grow your wealth? Let's find out in today's video. Hey, welcome to Stock Market Mate. Today we'll talk about how to invest in dividends for passive income. Before we get into it, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. Understanding dividend stocks. Dividend stocks are payments from companies which are distributed to their shareholders either yearly or monthly. Some dividend-paying companies pay their shareholders special dividends, which is also known as a one-time dividend, and is kind of like a bonus they give out to their investors, especially if the company is generating profits increasingly. Moreover, there's two ways a dividend stock provides a return. One is through regular income from dividends, and the other one is through the stock's price's capital appreciation. By definition, capital appreciation is an increase in an investment's price. For example, say an investor buys a stock for a market price of $10 per share, then the stock price increases to $12, which ultimately means the investor has gained $2 through capital appreciation. Furthermore, dividend stocks also have less market volatility, meaning it has lesser risk than the average stocks. This is why dividend stocks are appealing to investors who have a low risk tolerance and are looking for a more steady investment. However, this doesn't necessarily mean that dividend stocks have zero risks, which is why it's important to be aware of the things you need to avoid in order to effectively gain regular income through dividend stocks. So to sum it up, purchasing share of a company that pays out dividends is undoubtedly a great way to invest and gain more money. Although due to its steadiness, many investors may find dividend investing less interesting. Which is not really the case, as dividend investing does include risks, which means planning for a good strategy is going to take caution and a lot of research. Which is why it's important to keep in mind the disadvantages that go with the benefits of dividend stocks, to really know what you're getting yourself into and make the most out of your investment. Perhaps the number one downside to dividend stocks is that they're not all guaranteed, unfortunately. This means that companies can pretty much cut their dividends anytime they want or see fit. Dividends are also only paid by larger and more mature companies, meaning that small businesses will likely not pay their shareholders dividends. How to tell if a dividend stock is worth investing, or dividend yield versus dividend growth. Since there's a downside to dividend stocks, choosing the right stocks to invest in is more important in preventing these risks. Most, if not all, investors usually make the mistake of looking for stocks with high dividend yields. While it looks promising on the surface, it's usually a sign of a company's struggle, which means in most instances, stocks that have higher dividend yields are usually a big trap. But don't get us wrong, looking at dividend yields can be a great way to evaluate which dividend-paying stocks are best to invest in. As a matter of fact, there are a lot of websites online that help investors look for high-yielding dividend stocks. However, it is not the only thing to look at when analyzing a company, because at times, stocks with high dividend yields can be quite deceiving. Hence, it's important to remember that high yields is not everything. Because while high-yielding dividend stocks aren't necessarily a bad thing, most of the time it can be due to a decrease in stock price, which is an indication that the dividend is at risk of being cut. This is ultimately known as the dividend yield trap, which investors need to watch out for. In order to avoid falling into this trap, here are the things that you need to remember when picking dividend stocks. Take into account the company and the industry as a whole. Are competitors, weak demand, or some other disruptions threatening the company's business? Consider its strengths and weaknesses to determine whether it's a healthy company or not, as well as its potential. Examine the balance sheet, which includes the debt, cash, and liabilities. Examining these data give you more insight to the company's performance. As a guide, check the company's dividend history, both payout growth and yield. This will help you get an idea of the company's stability. Assess a dividend sustainability by looking at its payout ratios. The payout ratio indicates the portion of a company's profits paid as dividends to its shareholders. This calculation is made by dividing the net income generated by the total dividends being paid. Dividend yield should not be the only factor to consider when buying stocks. If a company's yield significantly exceeds that of its competitors, that's a sign of trouble, not opportunity. If the dividend yield looks too good to be true, it often is. Hence, it's more ideal to purchase dividend stocks with lower dividend yield, as that's usually more reliable. In doing so, you're considering the company's dividend growth instead, which, more often than not, proves to be better at providing increasing income for investors. This emphasizes the key element in picking dividend-paying stocks, which is reliability. Investors need to ask themselves the question, is this company stable enough to pay dividends, perhaps even increasing them over time? A good way to find great dividend stocks is to look through the Dividend Aristocrats, which is a list of stocks that have been increasing their dividends over time for the past 25 years. There are also stocks in certain sectors that may pay higher dividends, such as utilities and real estate. Dates to remember when investing in dividend stocks. To further understand dividend-paying stocks, it's also important to have knowledge on important dividend dates. So if you're considering investing in dividend stocks, here are the 4 crucial dates that you need to keep in mind. Number 1. Declaration date. The declaration date is the day a company declares they're going to pay a dividend to their investors or shareholders. What happens is that the board of directors announces and approves the payment of a dividend. They also include the size of the issued dividend as well as the payment date. For example, on March 25, 2022, Altria Group Incorporated announced that its board of directors declared a regular quarterly dividend of $0.90 per share. Number 2. Exdividend date. If you own a stock of a company before this date, then you'll be entitled to receive the dividends they will pay, which means that shareholders who purchase shares on or after the ex-dividend date are not entitled to a dividend. Number 3. Record date. Also known as the date of record. The record date is the date which the company goes through their list of investors who will receive a dividend payment. Most of the time, the record date is confused with the ex-dividend date. Although one thing to remember so that you won't confuse the two is that the record date is usually set by the company while the stock exchange sets the ex-dividend date. Number 4. Payment date. This is the day when the company distributes dividends to its shareholders. The dividend payments are either mailed or transferred electronically to accounts of shareholders. All in all, these are some of the things you need to know about how to invest in dividend stocks in order to receive passive income. Keep in mind that it's important to look for dividends which are safe, meaning you need to examine the odds or likelihood of a company keeping their dividend payments as well as increasing them over time. While some companies evaluate and rank dividend safety, you can also do your own research to find out more. Comparing earnings to dividends is one way to learn more about a company. Another way to determine dividend safety is by how risky or new a business is. Despite having a low dividend, your payment will actually be at more risk if the business is not stable or reliable. Hence, don't just look at high dividend yields when looking for dividend stocks to invest in. Always consider other factors as well as decrease your exposure to unfortunate risks. Well, that's about it for today. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!